Hello guys,
Hello,
Hi everyone,
Hello,
Hello,
my name is Inika Perona
my name is Lukmanul Hakim.
my name is Dayang Anissa Safitri
my name is Marlene Fajrin.
my name is Alessandro.
from Group 2.
from International Management Class, Faculty of Economics and Business Untan.
Here I will explain you about allocating of funds. Allocating funds is the process of channeling funds collected from the general public back to people in need. The allocating of funds is usually realized in the form of loan, or what is referred to as a credit, where in the process there is an agreement that is mutually agreed upon. Activities for allocating funds can be in the form of loans or what is referred to as credit, where this principle is usually used by conventional banks. While for banks that adhere to Sharia principles, it is referred to as financing. The difference between credit and financing lies in the expected of profit. For conventional banks, the profits are obtained through interest. The benefits are in the form of rewards or profit sharing. The elements contained in the credit granting process are trust, agreements, term, risk, and remuneration. The next is the goal of credit. The goal of credit itself is to make a profit, assist customer business, and assist the state's finance, while the function of credits are to increase the efficiency of money and goods, to increase the circulation of money and goods as a means of economic stability and increase income distribution. I think that's all material from me, and next material will be explained by Lukman. Thank you.
Now I will explain about types of credit. There are several types of credit that can be seen in various aspects. First is types of credit based on use. There are two types. First is investment credit. This type of credit generally has a long repayment period. Next is working capital credit. This type of credit is used to increase the capacity of production operations. Working capital loans are given for payment of wage, purchase of raw materials, or other matters related to the company's production activities. Next is types of credit based on purpose. First is productive credit. This type of credit is used to increase revenue. The second, consumer credit. This type of credit is used for personal purposes. The third, trade credit. This type of credit is used in trade to provide loans by one trader to another trader. Next is types of credit based on the time period. The first is short-term credit. This type of credit has a term of less than 1 year. Next, the second, medium-term credit. This type of credit has a long period of approximately 3 years. Next, the third, long-term credit. This type of credit has the longest term of return, which is over 3 years or 5 years. Next, types of credit based on collateral. First is guaranteed credit. This type of credit is provided with a guarantee, which can be in the form of goods or people guarantees. Next is unsecured credit. This type of credit is given without collateral in the form of goods or people. Next, types of credit based on business sector. First is agricultural credit. This type of credit is used for the plantation sector and smallholder agriculture. Next is housing loans. This type of credit is used for the cost of building or buying a house. Next is professional credit. This type of credit is given to professionals such as lecturers, lawyers, and doctors. And there are many other sectors. Now I will explain about credit guarantee. Having a credit guarantee makes it safer because the guarantee can cover all bad credit, so that it makes easier for banks to deal with customers if they experience bad credit. Types of collateral that can be used as loan guarantees by prospective debtors are: first, with guarantee. There are three types of guarantee. First is tangible guarantee. Guarantees in the form of goods whose existence can be seen and can be used as collateral. Second, intangible guarantee. Guarantees that cannot be seen physically but are documented in letters. Next, personal guarantee. Collateral in the form of a person who bears the risk to the person who is given the guarantee in the event of bad credit. The next is unsecured. This credit is usually given to the companies that are truly professional. Therefore, the company doesn't give guarantee certain goods because the possibility of bad credit is very small. Now I will explain about the principles of granting credit. There are several credit assessment principles that are often carried out, namely the 5C analysis and 7B analysis. The principle of granting credit with the 5C analysis is as follows. First is character, second capacity, third capital, fourth collateral, fifth condition. And the principle of granting credit with the 7B analysis is as follows. First is personality, second party, Third is purpose, four is prospect, and fifth is payment, six profitability, seven protection. Now I will explain about aspects of credit assessment. There are several aspects of credit assessment. First is juridical or legal aspect, assessment that aims to determine the legality of permits owned by companies applying for loans. Second, marketing aspect, assessment in this aspect is the amount of demand for products produced in the present and in the future. Third is financial aspect. In this aspect, assess how the source of funds used to finance the company and the use of these funds. The fourth, technical or operational aspects. These aspects related to production issues such as machine types, machine capacity, location problems, and others. Fifth, management aspects. This aspect aims to assess the organizational structure of the company and its human resource. Sixth, socio-economic aspect. This aspect aims to investigate the effect on the economy and society, such as reducing unemployment, increasing people's income, and others. And seven, AMDAL aspects. This aspect analyze the impact on the environment if the project is implemented. I think that's all from me, and thank you.
Now I will explain about credit granting procedure. Procedures of granting credit are generally differentiated between personal and legal entity loans. It is also possible to check whether the purpose is consumption or productive. Granting credit procedures by a legal entity will do 1. Submission of files. The credit applicant submits a credit application in a proposal along with other required documents such as background of the company, the aims and objectives, credit guarantee, and in the credit guarantee will complete the documents like notarial deed, TDP or company registration certificate, and PWP or taxpayer identification number, balance sheet and income statement for the last 3 years, how applicants return credits, and then proof of identity from company management, and then photocopy of guarantee certificate. And then number 2, credit file review. The purpose is to check if the file submitted is complete and correct according to the requirements. And then number 3, bank will do the first interview to the applicant. And then number 4, on the spot, is what we see in the field corresponds to the actual conditions. And then number 5, bank will do second interview. And then 6, credit decision to determine whether credit will be given or rejected. And then number 7, signing of a credit contract or other agreement. 8, credit realization. 9, distribution or withdrawal of funds. Okay, now I will explain about the credit quality. The bank's survival depends on the amount of credit disbursed in a period. That is, the more credit extended, the greater the profit from the sector. In practice, the large number of credits disbursed, attention should also be paid to credit quality. In other words, the higher the quality of the credit, the lower the risk of problems with the credit. It is not excluded that a large number of credits will lead to losses if the transferred credit is of poor quality and leads to a problem credit. In releasing credit so that the bank is qualified, it is necessary to pay attention to 2 elements, such as 1. The level of return is the bank's profit that get from lending. To be considered healthy, the amount of profits earned must comply with applicable regulations. Number 2, the level of risk. This means that the level of risk that will be faced against the possibility of missing the bank's profit from the credit distributed. In general, the types of risks that bank's profit may or will be faced include environmental risk, financial risk, and delivery risk. Separation of function within a credit organization must also take into account the existence of dysfunction. The separation of function in credit organizations, in general, consisting of 1. Credit marketing, number 2. Credit analysis, number 3. Collateral taxation, number 4. Credit administration, number 5. Credit audits. The purpose of this separation of credit function is none other than so that the management of a credit application can be processed correctly, completely, thoroughly, and perfectly so that it has a lower risk and does not cause problems. The duties of the credit committee such as making decisions and reviewing new credit, ensuring the completeness of credit documents, approval of credit extensions, changes in credit terms and conditions. And then the Bank Indonesia classifies credit quality such as fluent, special mention, substandard, doubtful, and lows, with different specification and explanation for every classification of credit quality. Okay, now I will explain about repression technique. Repression technique can occur because it is caused by 2 elements, such as 1 from the banking side. This means that in carrying out the analysis, the analyzed is not true, so that what should happen is not predicted in advance. Number two, from the customer side, two things that makes the credit condition. There are element of intent. The customer deliberately does not intend to pay his obligations to the bank, so that the credit provided is bad. It can be said that there is no element of willingness to pay. And repayship is done in the following way, such as rescheduling can extend the credit term and extend the installment period. And then number two, reconditioning, such as capitalization of interest, postponement of interest, payments until a certain time, lower interest rates, and interest exemption. And then number three, restructuring by increasing the number of credits and by adding equity, like by depositing cash additional from the owner. And the number four, combination, the combination of rescheduling, reconditioning, and restructuring. Collateral forfeiture is the last resort of if the customer really has no etiquette, either or is no longer able to pay all of their debts.
Now I will explain about examples of allocating funds, definition of interest, and factors that affect interest rates. Here I will explain about the examples of allocating funds, that is, the People's Business Credit Programs or Kredit Usaha Rakyat. The People's Business Credit Programs or Kredit Usaha Rakyat is one of the government programs to improve access to financing for micro, small, and medium enterprises or MSMEs, which are channeled through financial institutions with a guarantee scheme. The People Business Credit Programs is intended to strengthen business capital capabilities in the context of implementing policies to accelerate the development of the real sector and empower MSMEs. And we're going to the definition of interest. According to Kashmir, states that bank interest can be interpreted as remuneration provided by banks based on conventional principles to customers who buy or sell their products. According to Kashmir, conclude that in daily banking activities consists of two types interest, namely saving interest and loan interest. Factors that affect interest rates. To determine the size of the interest rates on deposits and loans is greatly influenced by both, meaning that both interest on deposit and loans influence each other. In addition to other factors, there are supply and demand. When there is high demand for credits, lenders can increase their rates as they have more opportunities to lend out money at higher returns. Government policy. The government also plays an important role in determining interest rates, as they use this to influence economic policy. Need for funds. If the bank is short of funds while the loan application is increasing, what the bank does is to fulfill these funds quickly by increasing deposit interest rates. Competition. In competing for deposit funds, besides the promotion factor, the most important thing is that banks must pay attention to competitors. Desired profit target. If the desired profit is large, then the loan interest will also be large and vice versa. Time frame. The longer the loan term, the higher the interest. Quality assurance. The more liquid the collateral provided, the lower the loan interest charge. Company reputation. The bona fide company that will obtain very high credit determines the interest rate that will be charged later. Competitive products. For competitive products, the loan interest given is relatively low when compared to products that are less competitive. Good relation. The main customer usually has a good relationship with the bank. The determination of interest rates is different from the ordinary customers. Third-party guarantees. If the three guarantors are less bona fide or unreliable, then the bank may not be able to use it as a third-party guarantee. Okay, that's all. Thank you for the attention and see you next time.
I'm going to explain about the interest rate sections, about the components that affect credit interest, type of interest rates, and the example questions about the interest rate. So we're going to the number one. It said there's several components that affect credit interest, including interest rate, loan term, government regulations, borrower's credit profile, economic condition. Interest rate is the base interest rate that determines how much a bank or other financial institutions will charge as loan interest. And for the loan term, it's the longer the loan term, the higher the interest that must be paid. This is because the risk of the borrower failing to repay the loan becomes higher over time. And for the government regulations, there's some governments have regulations that limit the interest rates bank can charge. And we're going to this types of interest rate. There's several of type interest rates. The first one is a fixed interest rate. That means a payment of interest rates and a fixed amount and does not depend on the economic situations. The references the interest rate predetermined by the lender. And for the second one is a floating interest rate. That's mean interest payment that can vary according to the change in economic condition, such as inflation rates or marketing interest rate. And number 3 is a multiple interest rate. Number 4 is a base interest rate. And number 5 is effective interest rate. That's mean the interest rate that include all costs associated with the loan, such as administrative fees and other costs. And the last one is example questions about the interest rate. So if we have a customer borrow $10,000 at a fixed rate 5% per year, how much interest must be paid annually? So the customer must be paid $500 because the amount of interest will be recalculation with $10,000 multiplied by 5% per year. So we get the $500. So the customer must be paid $500 for the interest fixed rate. I think that's all from me. So thank you.